Whether you're anticipating a future crash of Bitcoin, BTC/USD, or not, shorting the currency could be an attractive choice. Shorting any stock or crypto is essential to becoming a complete trader or investor in the stock or cryptocurrency markets. Smart traders and investors learn early on how to make money no matter what the market is doing. Up, down, or sideways, there's always a way to profit. The growing mainstream recognition of cryptocurrencies has expanded the avenues and techniques available for shorting Bitcoin. Here are several approaches for you to consider. Key takeaways. Numerous options exist for shorting Bitcoin, allowing investors to profit from betting against its price. Short exposure can be achieved through derivatives like options or futures, as well as margin trading on specific crypto exchanges. Caution is advised when shorting due to the volatile nature of Bitcoin and the risks inherent in unregulated crypto markets. A. Margin trading. One convenient way to short Bitcoin is via cryptocurrency margin trading platforms. These platforms allow investors to borrow funds from brokers to execute trades. However, margin trading involves leveraging and borrowed capital, which can amplify gains or losses. Prominent exchanges like Kraken and Binance offer margin trading for Bitcoin. B. Futures market. Bitcoin, like traditional assets, features a futures market. By engaging in futures trading, traders speculate on the future price of Bitcoin. Purchasing futures contracts is bullish, whereas selling them indicates a bearish stance. Bitcoin futures are accessible on diverse platforms, including the Chicago Mercantile Exchange, CME, popular crypto exchanges, and brokerages such as eToro and TD Ameritrade. C. Binary options trading. Call and put options also facilitate shorting Bitcoin. Opting for a put order allows selling Bitcoin at the current price, even if it declines later. Binary options trading is available through various offshore exchanges, although associated costs and risks can be high. Notably, options trading, such as on Deribit and OKEx, provides more controlled losses compared to futures trading. D. Prediction markets. Prediction markets enable shorting Bitcoin by betting on potential price declines. These markets are akin to mainstream equivalents, allowing investors to create events and wagers based on price outcomes. Crypto prediction markets like Augur, Gnosis DAO, and Polymarket offer opportunities to profit from accurate predictions. E. Short selling Bitcoin assets. While unconventional, short selling Bitcoin assets can yield gains if price predictions are correct. Investors sell tokens, wait for a price drop, and then repurchase tokens. This method entails costs and risks, including custody fees and Bitcoin's inherent volatility. Leverage options on certain exchanges can amplify gains or losses. F. Using Bitcoin CFDs. Contract for differences, CFDs, pay out based on price differences between opening and closing prices. Bitcoin CFDs function similarly to futures, allowing traders to short Bitcoin by predicting price declines. CFDs settle in fiat currency, eliminating the need to own or store Bitcoin. They offer flexible settlement terms and can be based on Bitcoin's performance relative to fiat or other cryptocurrencies. G. Using inverse exchange traded products. Inverse exchange traded products, like ProShares, Short Bitcoin Strategy ETF, BITI, offer opportunities to bet on price declines. Non-US investors can access similar options, such as Beta Pro Bitcoin Inverse ETF, BITI, in Canada, or 21 shares Short Bitcoin ETP in the European Union. Considerations when shorting Bitcoin. Shorting Bitcoin involves significant risk, with several factors to bear in mind. Bitcoin's volatile nature influences derivative-based shorting strategies. Bitcoin's relatively short history and lack of data introduce uncertainties. Regulatory ambiguity can affect the availability and safety of trading platforms. Knowledge of order types is essential for managing losses. Shorting Bitcoin with leverage magnifies risks and rewards. Conclusion: shorting Bitcoin. Investors can indeed short Bitcoin by using derivatives like futures and options, but they should carefully assess the associated risks. Common methods include shorting derivatives, utilizing CFDs, engaging in binary options trading, and participating in prediction markets. If you are new to this, I strongly advise you to use a great deal of caution due to Bitcoin's volatility, regulatory uncertainties, and potential leveraging effects. I hope this gives you a clearer understanding of what is needed to short Bitcoin and other cryptocurrencies. Disclaimer: all of the Crypto Underground posts are based on my opinions alone and are for informational purposes only. You should not take any of this information as guidance or advice for buying or selling any type of cryptocurrency. I am not a financial advisor, and anything that I say on this channel should not be seen as financial advice of any kind.